welcome to the channel. Now, let me ask you something that might surprise you. What if I told you that Betty Buzz, the company associated with Blake Lively through her affiliate company LOL Hada, has actually been struggling financially? Not recently, but even before the film, before the alleged smear campaign, before all of that noise began. Yes, that's the claim being made. And here's where things get more complicated. The company people often call Blake Lively's company isn't completely hers at all. The official entity is named Betty B Holdings, and it is owned by a group of investment firms and partners. Names such as Ipin Holdings LLC, LOL Hata, Belelfer Capital Partners, Graver Fusa LLC, and ACG Buzz LLC are all part of it, and other admitted members as well. In short, this is not a one-man show. It is a group of investors and capital partners who came together to form the brand. Blake Lively, in short, is the face of it. Behind the scenes, the company is run by a group of individuals such as Andrew Kazmulis, an individual with the last name Belair, and Blake Spawn. On the talent management side, both Blake Lively and Ryan Reynolds are listed. Belelfer is associated with Jody Gans, while Blake and Ryan are the recognizable public figures associated with the brand. So when legal claims are made about damages to Blake's company, it's important to remember that this business is also tied to Ryan Reynolds and multiple investors. It's not solely her personal venture. And interestingly, the company agreement includes a morality clause. This clause allows the board to remove Lively or Reynolds as managers if a certain type of reputational event occurs. Now, this clause doesn't say they must commit a crime. It doesn't even require anything illegal. Simply states that if reputable major publications, similar in stature to the New York Times, report something that shocks, insults, or offends a significant portion of the public, and if that reporting causes lasting harm to their public image or the company's image, the board could vote to remove them from management. In other words, reputational damage alone could be enough to trigger serious consequences. That detail becomes especially interesting when we look at Blake Lively's promotional choices during the press tour for It Ends With Us. At the time, she promoted her beverage line heavily. One product, a drink called While You Wait, referenced the film's abusive character. She reportedly brought cans of her beverages to interviews, offered them to journalists, and even featured the drinks at the after-party. The film's marketing was tied closely to her brand with slogans like "It Ends With Buzz." Whether intentional or not, these moves drew scrutiny. Critics questioned whether linking a beverage promotion to a story about domestic abuse was appropriate. And once public perception begins to shift, it can affect not only personal reputation but also corporate standing, especially when a morality clause is involved. Another layer to this story is ownership. Blake often speaks of Betty Buzz as her company, but the numbers show a more complex picture. She and Ryan Reynolds together hold a minority share. They reportedly invested around $2.1 million for roughly 30 to 32% ownership. Meanwhile, Ipin Holdings contributed about $15 million but received only 25%. That difference highlights how celebrity branding can influence equity stakes, because the talent brings visibility, not just capital. There's also the involvement of Maximum Effort Marketing, Ryan Reynolds' marketing company. Some of its employees receive incentive units tied to profits and performance, meaning they directly benefit if the brand succeeds. So while Blake is the public face, Ryan's business network plays a significant role behind the scenes. Even his business partner, George Dewey, reportedly helped produce and fund parts of the project. When you step back and look at the full structure, the company appears less like a solo celebrity venture and more like a collaborative investment machine built around star power. Blake and Ryan didn't put in the most money, but they provide the visibility and brand identity that help the product stand out in a crowded market. And this leads to a rather interesting question. How exactly is the damage assessed if it is reputation-related, and if the brand is shared by many investors? Particularly when the celebrity at the forefront of it all has only a minority stake, even as they are the face that the world sees. It is a complex interplay of ownership, image, and business acumen, one in which perception may very well be as valuable as profit. Well, in essence, what Blake Lively and Ryan Reynolds are actually worth to this company is not simply their financial input. It is their faces, their fame, and their image. The investors and companies are, in essence, saying, "Your reputation is worth this much to us." This means that Blake and Ryan have a certain responsibility. They have to protect that image not just for themselves but for the people who invested millions along with them. From that perspective, it helps explain why Ryan reportedly reacted so strongly to the marketing around It Ends With Us. He was deeply involved in the promotional strategy. Campaigns for Betty Buzz and Betty Booze were tied into the film's marketing, and those campaigns are handled by Maximum Effort, Ryan Reynolds' own marketing company. In a way, he has built a business model where he becomes the recognizable face of a brand and then his marketing company promotes it. Some critics say it almost looks like a small empire built around personal branding. Yet publicly, the messaging often presents Betty Buzz as a woman-led company, even though the board itself is largely made up of men, with Blake and Ryan serving mainly as talent representatives. Because of that structure, their reputations are directly linked to the company's stability. Public perception collapses, they could be removed from leadership and even lose the money they invested. That's not just theory, it's part of how the agreements are written. Now, there's another interesting detail that's surfaced in a deposition. Andrew, who later became CEO of Betty B Holdings, said he didn't step into that role until 2025. Previous CEO Nishit Gupta left, and it was described as an amicable departure. During questioning, Andrew explained that Betty B Holdings is, at its core, a beverage company focused on non-alcoholic and low-alcohol drinks. Sales of non-alcoholic products began in 2021, and alcoholic beverages were added later, around 2023. He also clarified that the corporate structure includes multiple entities formed over time and then connected together. For example, a separate subsidiary was created when they introduced the alcoholic product line. The reason, he said, was to keep corporate reporting clean and organized, one entity for non-alcoholic products and another for alcohol-related products. When asked about performance, Andrew acknowledged that 2024 sales were lower than expected. Company had projected selling around 200,000 cases but ended up closer to 125,000. He also referenced internal analysis suggesting that, while there were some promising signs, the brand's product-market fit at a large scale was still unclear. In plain language, that means they hadn't fully broken through in a crowded market. The biggest competitors in that space, premium mixer brands like Fever-Tree and Q Mixers, have far more capital and established market share. According to his testimony, Betty Buzz had managed to become the number 3 brand in the premium mixer category after 3 years, but it still hadn't significantly eaten into the market dominance of those bigger players. In other words, the growth challenges existed long before any alleged smear campaigns or controversies entered the picture. This point becomes important when discussing financial losses. Company had ambitious projections from the start, even hoping it might eventually reach billion-dollar status. But those projections were always speculative, based on future growth rather than guaranteed results. And because the company is owned by multiple parties, including LOL Hata, which is jointly owned by Blake and Ryan, the legal argument about personal damages becomes more complicated. A minority owner cannot easily claim that all reputational harm translates directly into personal financial loss. There's also the contractual side to consider. By signing agreements tied to the brand, Blake committed to maintaining a positive public image. If her actions were seen as harming the company's reputation, investors could potentially argue she violated that duty. In that case, the consequences could go beyond removal. They might include financial liability for damage to the brand itself. From this viewpoint, some observers speculate that the lawsuit may serve another purpose: shifting blame. If reputational harm can be attributed to an external smear campaign rather than to her own decisions, then the responsibility moves away from her and onto someone else. That distinction matters because if investors believe the damage came from her own actions, she could face claims of breaching her contractual obligations. And this model isn't limited to one brand. Similar arrangements exist with other ventures tied to her name, where she serves as the licensed face or talent rather than the product creator. She didn't personally formulate the products or build the companies from scratch. Instead, she agreed to represent them publicly, lending her image and influence. That means she carries both a moral and professional obligation to protect that image. The larger pattern seems to have begun after Ryan Reynolds' major success with Deadpool. Once his star power surged, he began attaching his name and persona to various brands, Aviation Gin, Mint Mobile, and others, while leveraging his marketing company to promote them. The idea, it seems, was that the same strategy could also work for Blake. Build brands around celebrity appeal, then let marketing amplify that connection. The argument being made here is that after investing heavily in these ventures, Ryan Reynolds and Blake Lively continued to behave the same way they always had, confident, assertive, and in the critics' view, sometimes overly forceful, while expecting little pushback. Claim is that this approach may have worked in the past, but now, with investors and partners involved, the stakes are much higher. If their public actions hurt the brand, then it isn't just their personal reputation on the line. It also affects everyone who invested money and trust in the business. That, the speaker suggests, is where the real tension lies. Looking at the financial side, the numbers being discussed paint a difficult picture. According to the filings referenced, Betty Buzz reportedly generated no positive income over the last 2 years. In fact, after the introduction of the alcohol line, the company posted losses. By the end of 2023, the net business income was said to be negative $446,000. And notably, Blake and Ryan's own company reportedly received no payouts during that period. Nothing at all. The following year appeared even tougher. In 2024, additional capital had to be injected into the business to support the alcohol expansion, and the company reportedly showed a loss of around $3.4 million. Once again, Blake and Ryan didn't earn profits from the venture. Instead, they contributed more funds and even had to cover minimum tax obligations. In simple terms, the company wasn't generating income for them, it was costing them money. During deposition testimony, it was also suggested that these financial struggles began long before any negative publicity or alleged smear campaigns. When asked whether poor performance was caused by bad press, the response given was no. Company, according to that testimony, had already been facing growth challenges for several years. There was even discussion about long-term strategy. The idea wasn't necessarily to run Betty Buzz forever as a standalone powerhouse. Instead, the hope seemed to be that the brand would grow enough to attract a large beverage corporation. Plan would be similar to what has happened with other celebrity-backed brands: build awareness, expand distribution, and eventually sell the company to a bigger player. In deals like that, the celebrity face often receives a mix of cash, stock, and performance-based incentives rather than a straightforward billion-dollar payday. This is why some so-called billionaire headlines around celebrity business deals can be misleading. Much of the valuation is tied to stock performance and long-term brand success, not guaranteed cash in hand. So while the numbers can sound enormous, the actual realized earnings may be far smaller and spread out over time. From this perspective, the critic argues that the brand's struggles are not simply the result of outside attacks or negative media coverage. Instead, they see them as the outcome of a business model that relied heavily on star power to drive growth in a competitive market dominated by well-funded competitors. If the brand didn't scale fast enough, investors might naturally become concerned, regardless of any controversy. The broader claim is that Blake and Ryan positioned the company publicly as a woman-led venture, while internally it functioned as a joint effort with significant involvement from Ryan's marketing firm and business partners. In that light, Blake's role is described less as a traditional founder and more as the public face and licensed talent tied to the brand's identity. The conclusion drawn by the speaker is blunt. If the company was already struggling financially, then proving that reputational damage alone caused the losses could be difficult. And if that argument fails, it could open the door to disputes with partners or even potential legal fallout tied to contractual obligations. In that scenario, the lawsuit itself might be seen as a way to shift responsibility and protect both careers and long-term wealth. Ultimately, the commentary frames this conflict not just as a legal battle, but as a high-stakes fight over reputation, brand value, and investor confidence. When celebrity image is the core asset of a company, any controversy can ripple outward, affecting contracts, partnerships, and future deals. That's why, in this telling, the situation is about much more than one film or one promotion. It's about whether the public image that once powered the brand is now working against it. And with that, the speaker closes by asking viewers to reflect. Does the public perception of celebrity wealth always match reality? Or are many of these ventures far more fragile than they appear from the outside?